Good morning, everybody. This is the live market open for Wednesday, December 16th, and I guess you all know today is the big Fed day. I'm Yohay Elam, a Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. We'll talk as usual what happened in markets, recent developments, charts and levels the next 24 hours, one big event there standing out, and of course looking forward also to your questions as usual. If you can't see the chat box under the video, please go to the address here on the screen, tlk.io/fxstreet-forex-live-video. So before we get to the Fed, let's see what happened recently in markets. First of all, the dollar got stronger yesterday. No apparent reason, no risk on, risk off, just strengthened against almost all currencies. Just some repositioning. It lost ground beforehand. Now it's stronger. Lots of tension in markets towards this big day, and also lots of positioning and low liquidity. We're getting close to Christmas. It's 9 days away, and the new year, and this is an illiquid time. Less liquidity means more violent movements, and that you should trade with less leverage. Apart from that, we had UK inflation coming out exactly as expected, 1.2% on the core. German ZOO slightly beat expectations, and nothing really astonishing. I think we talked about it probably coming out better than expected. The most important event from yesterday was US inflation. It again came out as expected, no surprise, but sort of good enough for the Fed. If there were any obstacle for the Fed to hike, it would be from weak inflation, and it was good. It rose from 1.9 to 2% year over year in the core figure, which is what interests the Fed. The Fed doesn't really look at food and gasoline. Well, it does if it moves into other figures, but they focus on core inflation. The US Empire State Index manufacturing was negative, but better than expected. We all know that manufacturing in the United States and in general in developed countries is not what it used to be. Canadian manufacturing sales disappointed, but they didn't move the loonie too much. The Canadian dollar moves more on oil. What did move markets a bit is milk prices in New Zealand. They rose for a second consecutive time, and this is why the New Zealand dollar stood out just a bit against the US dollar, against the trend. Okay, so I talked about what happened. Let's see how it looks on the charts. So this is euro dollar, where we've seen, if you wish, it's these moves right up here are higher highs. Okay, but perhaps it's just a double top or just an attempt to move higher without success now. Okay, 110.70 worked as resistance. The pair eventually dropped below the round number of 110. I see 109.50 as some kind of weak resistance. Anyway, we're currently in their range. We will have a much wider range just before the event, and of course afterwards. Levels to watch on the downside: 108.30 despite the breach, 107.60, 106.30, 105.30, and of course 104.60. On the top side, 110, 110.70, 111.30, 112.15, and 114.60. Okay, pound dollar inflation data was okay, but when the US dollar strengthened once again, it exposed the weakness of the pound. 150.40 is the current level. Support, of course, is the round number of 150, followed by 149.50, and 150.115 still works as resistance. I think we can see here some kind of head and shoulders pattern. Shoulder, head, and shoulder, a bit choppy, but the pair fell below it. 151.15 is a significant resistance, followed by 152. Another thing regarding the pound yesterday. The governor of the Bank of England, Mark Carney, spoke, and he talked about sort of maintaining inflation, and he expressed some worries so it could dampen the pound, but nobody's listening to any central banker today apart from Janet Yellen. Okay, dollar yen, very nice technical behavior once again. We saw a stronger dollar against the yen, 122 at the moment. 122.20 is very, very strong resistance. I think it's an excellent pair in terms of technical movements. As you can see, 122.20 to 123.60 was the previous range. Then we fell, got close to 120. Now we're moving above. 122.20 is strong resistance. Dollar CAD, well, it did. I put this line yesterday saying the sky is the limit. It's not a real line, 137.87, but so far it's holding because oil prices did stabilize, but the Canadian dollar is weakening once again against the strength of the US dollar. 137.47 current level, 136.20 support, 137.87 is some kind of resistance. Aussie dollar, in theory, everything is positive for the Aussie. China is relatively stable. We had good figures over the weekend, good employment figures, but stronger US dollar, back to the previous range. Like dollar yen, also here we have very, very nice technical behavior. 72.80 is very clear as a separator of ranges. Also 72.20 is still of importance. 71.50 and 70.65 are levels to watch. The Reserve Bank of Australia doesn't intend to cut rates. It's happy with the current situation, and even with the Australian dollar, even though it won't admit it fully. Kiwi dollar, we heard from the Prime Minister in New Zealand that exporters prefer mid to low 60s, and currently we're mid to high 60s, but it's not such a big difference. 67.50 is the sort of current level. I still see 67.90 as resistance despite this breach. Milk prices remain supportive of the Kiwi, but there are stronger forces. US dollar 67 is support, followed by 66. On the top side, we have 69. And dollar Swiss moved higher with the stronger dollar, struggling with the 99 level parity. Sorry, 100.30 is a resistance, and I would say 97.80 support. But remember, this pair undergoes lots of intervention by the Swiss National Bank. Before we do a full preview of the Fed, let's see if you have some questions. Let's say good morning to all of you. I assume many of you are here because it's a big day today, right? So I'm sure you have some questions. Good morning, Sinatra. Good morning, Fabian. Good morning, Raz. I see lots more of you in the chat room, and I am looking forward to your questions. So, I guess it's time to stop beating around the bush, as they say, and talk about the main event, or the events for today. Let's do a little bit more of suspense, but we have one big event over there. So let's begin. We still have some important events now. First of all, we have the Eurozone PMIs released at the moment, and it's of course important for the euro, less so today. When do we have the numbers here? So we have markets manufacturing PMI in France beating expectations just a bit. That's good news for France, but services are not. Sorry, manufacturing and services a bit weaker. All in all, it's balanced. Services exactly the 50-point mark, separating growth from contraction, and is manufacturing better than expected. Later we have the preliminary figures also for Germany, which are perhaps more important because Germany is a larger country, and then for the Eurozone. More importantly, we have in the United Kingdom, in the UK, we have the jobs report. It's jobless claims for the month of November, and the unemployment rate and average hourly earnings for the month of October. What the most important figure here is average hourly earnings. This one, the headline figure. This is actually wages. So because when we have higher wages, we eventually have inflation. It stood on 3% last time, including bonuses. Now it's expected to drop quite significantly to 2.5%. Why is this important more than other figures? Because the Bank of England said that the rise in wages is flattening. Okay, so let's see if it's true. expectations are very low. Let's see if it's correct. This is the main figure to focus on. Excluding bonuses, we're also expecting a drop from 2.5 to 2.3. All in all, if you look at these charts of wages, we're seeing we're seeing an acceleration, which is good for the economy, good for inflation, good for a stronger pound. But the Bank of England claims it's not sustainable or it's flattening. Let's see what's going on with that. Then we have Eurozone final inflation data at 10 GMT. And also trade balance, which is somewhat overshadowed. We're expecting a confirmation of the preliminary figures, which stood on a rise of only 0.1 in the headline inflation and 0.9 in core inflation. But we already knew that ahead of the ECB, and since the ECB disappointed, change here in the final inflation figures for November is not likely to have a change. We'll have to wait for the preliminary fresh figures. As always, they have more impact. At 1:30, we have US building permits and housing starts, which is important, but today less important because of the Fed. Same goes for industrial output. Of course, if all figures go in one direction, it should have some kind of a small impact on the US dollar. That means if we have excellent building permits, superb housing starts, and impressive industrial output, we'll have a stronger dollar. If all of them are negative, we'll have a weaker US dollar. If they're mixed, and it often happens that we have good building permits, weak housing starts, or the other way around, especially on Fed Day, don't expect real movements. For those trading the Canadian dollar, of course, crude oil inventories do matter. They're expected to rise. And then, of course, drum roll, the Fed decision at 7 GMT. Okay, so let's see if we have any questions. Best currency pairs to trade, the dovish hike, and what we should expect from the dollar, strength or weakness. Okay, that's related to the Fed. We'll talk about that. I hope I'll answer your question in the Fed preview. Okay, so at 7 GMT, we're expecting the first rate hike since 2006. Historic rate hike. Is this event overhyped? I don't think so. I think it's a huge event. I think that it's mostly priced in. It will not be a surprise, but not fully, okay? That means the US dollar has room for strengthening. And of course, no hike will lead to a crash in the US dollar, a crash in the credibility of the Federal Reserve, euro dollar at 117, dollar yen at 115, things like that. Very improbable because the Fed gave us all the messages, including Janet Yellen, that said a delay to the liftoff has risks. Okay, so we're expecting a rate hike. Let's be clear on that. This is the CME Group FedWatch figures. Implied probability of rate hike according to bond markets. Clear to see 81%. Very stable in recent days. Economists also say 90% of them see a rate hike. Primary dealers, those working with the Fed, I think 17 out of 18, or if not all 18, see a rate hike. In other words, it's expected. Okay, so it's expected, perhaps not fully priced in. The statement will announce the rate hike, and the statement will also announce that the next moves will be gradual. So Janet Yellen and all her colleagues always say monetary policy will remain accommodative. That means we'll keep supporting the economy, move rates higher, but very, very, very gradually, okay? Because we want to support the economy, we're doing everything one step at a time, and that the Fed is data dependent. Good data means more rate hikes, weak data means less rate hikes in 2016, 2017. So if you hear that the rate hike is already priced in, that may be true, but also a gradual move, a dovish rate hike, which you referred to, is probably also priced in, okay? So there's a big question about how much of a graduality is priced in, and we can learn that from the next slide, from the dot plot, okay? What's the dot plot? The dot plot is an interesting and funny chart that shows us where all the members of the Fed, the voting ones and the non-voting ones, including the ones that participate now, but retire from the Fed next year, what they think about the current, what they think the hike path will be. What's important is, I think, less to look at the dot plot because it's a bit confusing. It's mixed. More important to look at the median. Okay. So these are the results of the median from the September meeting. The Fed releases the dot plot only once every 3 months, only every other meeting. In the recent one, they saw rates, the median, standing at 1.4 in 2016, okay, and 2.6 in 2017, and 3.5% in the longer run, okay, and it was dropped, okay. So this is the main chart to look at. This is a chart, of course, from September, not from tonight. It's not the future chart, but we have lots of figures here. Okay, let's go over them. Let's see what's most important. So first of all, let's look at the left-hand side of this chart, the median. Okay, median is more important than central tendency because the median is a snapshot. So, the central tendency is sort of a range of what the Fed thinks. Okay, so and please look at the bottom left of the chart. So we're expecting, look at the part saying Fed funds rate. They expected it in September to reach 0.4 as the median in the end of 2015, which means one rate hike, because currently it's a range of 0 to 0.25, and it's expected to rise to 0.25 to 0.5. So that's somewhere in the middle, 0.37, which is around 0.4, okay? And 1.4 in 2016, 2.6 in 2017, 3.4 in 2018, and 3.5 long term. Look at the line below this, the exact bottom, the bottom left here. You can see that projections, sorry, have been lowered in September from June. Okay, they're expected to be lowered again. All right, how much? This is actually the meaning of a dovish hike, that we're hiking now as the Fed, but we're sending a message that the next hikes will be low. Okay, I believe that what's priced in is 0.25% lower on all fronts. Okay, so let's say around 1.1% rate levels for 2016, and maybe 3.25% in the long run. Okay, 0.25 more or less lower. But if we have even much lower, 0.5% cut, especially for 2016, remember the markets are more focused on the shorter term than the longer run, then it will be much more dovish. Okay, the Fed forecasts are released together with the statement at 7 GMT. Okay, so that's the immediate reaction. What's in the statement and what's in the dot plot. Okay, so when we're talking about a dovish hike, we're talking about the dot plot first and foremost, and of course the statement. They'll again maintain the words of graduality, data dependent, but if you hear one and done, I don't think it's realistic. Okay, the Fed will not. I don't think they will raise rates today and tell us that it's over. Okay, it might be so. Things might get sour in the U.S. economy, the global economy, and then it might turn into a one and done. But they'll certainly not say it. If they do say it, which is a very remote scenario, I believe that the US dollar will crash. Okay, but again, highly unlikely. Mostly the statement will say gradual, data dependent, and look for the dot plot for hints. 0.25 lower is reasonable to expect. 0.50 lower would be dovish. If we have no change in the dot plot regarding the Fed's fund rate, if we have 1.4, 2016, 2.6, 3.4, 3.5, all the numbers you see here on the bottom, then of course it's hawkish. It's good for the US dollar. It's not really a dovish hike. Okay, so I talked a lot about the dot plot. Let's talk about other figures in the forecasts. Growth stood at median. Again, median is 2.3 and unemployment 4.8. inflation 1.7. All could be lowered a bit. The Fed is often optimistic about growth, so it can be lowered for 2016 from 2.3 to maybe 2.2, 2.1. The unemployment rate also could be lowered, which is of course good news, but we know that the low unemployment rate is also a result of low participation rate, and it's less important. Core inflation currently at 1.7 for 2016. There has been fear that inflation is lower. Look here, for example, for June, core PCE inflation. Remember, core is more important than headline. We had 1.7 for 2016, and beforehand it was 1.8. This time we might get 1.6. Remember, inflation is more sensitive and more vulnerable. So if you look at employment, you say raise rates. If you look at inflation, you say wait and see. Of course, the Fed needs to be ahead of the curve, anticipate inflation, raise rates before we have employment turning into higher wages and higher inflation. On the other hand, it can raise rates too strong and then choke the recovery. That's the huge dilemma. Okay, the forecasts are less important than the path of rates, the dot plot. Okay, and finally we have the press conference. This begins at 7:30 GMT. Main messages: gradual, data dependent, like in the statement, and that they haven't taken decisions for 2016. I'm sure reporters will ask, what's going to be the next? When is the next move going to be? In March, in January, in when, and how much is it going to be? And Yellen will deflect all the questions. Stick to the script. Gradual, data dependent. Wait and see. But we did begin a tightening cycle. It's not one and done. Okay, I believe my forecast is if the dot plot is relatively hawkish, again, a minor lowering of expected rate hikes, Yellen could be a bit more dovish, a bit more cautious, sort of more cautious about the global economy. Okay? In general, I think maybe now reach the answer to the question. If she has a confident message about the US economy in general, seeing it as growing, raising rates from a strong point, from expectations for stronger growth, for better global growth, sort of rosy glasses, glass half full, optimistic message, this could be good for commodity currencies. First and foremost, the New Zealand dollar, because New Zealand is less dependent on the Chinese moves. China is more vulnerable, but New Zealand exports milk. Australian dollar, because it's becoming more stable, strong employment reports. Canadian dollar at the bottom because oil prices are still close to the bottom. But again, if she has an optimistic message, it means also higher demand for oil, which is good for Canada. If she provides a dovish message about worries about impact of a stronger dollar to the US economy, for example, impact of weakening China, and we've seen the Chinese yuan devaluing in recent days, so maybe there are things to worry about. Still, lots of things to worry about over there. The Eurozone is the sick man of the global economy. You name it. Worried message, then the safe haven currencies, euro and yen, could strengthen. Okay? More things to look out for. Remember, a Fed decision is always a rolling event. It's not a one and done also in terms of reaction. There will be a second reaction at the Tokyo Open, a full reaction in the morning after, during our show tomorrow morning, and the echoes of this specific decision will be heard for weeks, if not months, because this is the first rate hike in 9 years, the first change of rates since 2009, a huge event. Analyzing the dot plot, analyzing the forecast, analyzing the message from Yellen, analyzing the market reaction, analyzing the analysts. Okay, we have a few Fed watchers. One of them is John Hilsenrath of the Wall Street Journal. What he says moves markets as well. Stephen Beckner of MNI, headlines in the Financial Times, which more or less opposes a rate hike. Headlines in the Wall Street Journal. and of course the headlines on our websites, on FX Street and on Forex Crunch. Okay, so we'll of course be here to bring you the best analysis possible. So I hope I answered one question. Let's see, we have more questions, of course. So the first question we had there, best currencies to and the dovish hike. On a dovish hike, I would, if I think answer. So, well, I think we'll have and a dovish hike, of course, will have a weaker US dollar. But if, again, if the message is we're supporting the economy and we're optimistic, it's good for commodity currencies, bad for the euro and the yen. If we're it's a dovish hike because of worries, and the other way around, okay? Another comment here, there's so many new analysts that have never seen other than NIRP. I think it's ZIRP you're referring to, so they don't know what to do for plus Fed rate. Yeah, many traders have never seen interest rates above zero, so um, here's some comments that you can't see me, you can't, I hope you can see and hear me. I see a comment from Jax. Anyway, yeah, referring to the comment here, many haven't seen a rate hike ever. So that'll be interesting to watch, of course. And that means that reactions could be wild. Reactions with low liquidity could be wild. We've already seen relatively extreme moves in markets in recent days. Also in oil prices, where we've seen these kind of exaggerations. Anyway, yeah, Fed let down markets many times. If you don't hike, it'll be like a dark hole for the USD. Yeah, if for some reason, for the lower oil prices, worries about China, worries about a stronger dollar, the Fed does not hike today against all its preparation, all its expectations, the US dollar will crash, the Fed will lose credibility. I don't expect this to happen. Even if the Fed decided, because of all these reasons, not to hike today, I think it's trapped in its own preparation, in its own work. Okay. So I hope that Sinatra and Jax, you can hear me and see me, because I've been talking for half an hour, doing a full Fed preview. Anyway, Ryan, I think, can hear me, and I hope the others can as well. I've never traded a Fed rate hike like many others. Better to trade the release or wait for the press conference. I would wait for the release. In general, you never know what they're going to say, so it's better to trade after the fact. If you do want to bet on the results, then please do it with a very, very small sum, because that would be a bet, not a trade. My tendency is to see a relatively hawkish dot plot, which will strengthen the US dollar, and then a more dovish Janet Yellen that could weaken it. But in general, that's sort of for the immediate reaction. Okay, for a stronger reaction, for a bigger reaction, we could see. Put myself on the screen so you can see me now. Anyway, for the longer, I think eventually my bet, or my assumption, my analysis is that we will have a stronger US dollar in the aftermath of this event, because a hike is still a hike, okay? It's still rates rising and not falling, all right? And regarding even if the path is gradual and the hike, this is also priced in, okay? So perhaps in the bigger picture tomorrow morning, I expect to see a stronger US dollar. We'll have lots of choppy reactions on the event. I believe we'll have, first of all, a stronger US dollar, then slightly weaker, but eventually stronger in the next few days, in the next few weeks. Afterwards, after this uncertainty will move away, I believe we'll have a weakening of the US dollar, but it'll be different against any currency. So that's my expectations, but I may be wrong. I was wrong with the ECB. It went too far, and you never know what they're going to do. Okay. Question here from Fabian. Given the 450 pip move of the ECB decision, what magnitude of move are you expecting today on euro dollar following the Fed decision? How many pips could the price oscillate up and down before taking a definitive direction? Perhaps 450 pips was too much, because expectations were they went into one direction, and then the actual outcome was so disappointing. So I don't think we'll have 450 pips, which was amazing on that day, December 3rd, a day I will not forget. But today we'll have, I believe, 200, 300 pips of range. I think it'll be much more choppy and less directional. So 200, 300 pips. It'll take time for a definitive direction. I believe first reaction will be to the dot plot and the statement, the actual announcement of the rate hike. Then during the press conference, we'll see lots of movement. Then when analysts will come out with reactions, we'll see more movements in Tokyo. Tomorrow, I believe, a full reaction, and so it's a rolling event. And look, if it'll be all hawkish, a rate hike, hardly any movements in the dot plot, and then a hawkish yell, and of course it'll be like the ECB. If it'll be all negative, a hint of one and done, or not one and done, but extremely gradual, very low dot plot, very dovish yell, and of course we'll see a weakening of the US dollar. But it'll be, I think, much more complicated with more moving parts. Okay. Yeah, thank you, Mauricio, for helping out here with the comments. Refresh the page if you can't see it. I'm not working on FX Street. I have my own website. It's Forex Crunch, and I have lots of collaborations with the good people on FX Street in terms of content and other collaborations. To answer that question, all experts say the stand at the sideline and watch the event unfold, then place your trade. Yeah, I certainly agree with that. Yeah, sorry for the inconvenience also on my behalf. You will first let the big money make its move. Yeah. What was the cause for yesterday's move across the board? Yesterday we had a stronger dollar. I think that it's just a reaction to a weaker dollar on the day before. We had some stability in oil prices after big falls, so that helped the dollar. That can explain sort of stronger dollar against the euro and the yen, the sort of safe haven ones, because it's sort of a relief rally. But it doesn't explain the stronger dollar against the Australian dollar, and the Australian dollar does have reasons to rise. So it's pure repositioning, no news, no risk on, risk off. And another thing that can explain it is just low liquidity. So a mix of repositioning, the Fed tension, and low liquidity. Another question, how do you think the Swiss franc will react to the hike, knowing that they have said their currency is overvalued? Remember, the Swiss National Bank is intervening in markets all the time. The Swiss franc is expected to move in tandem with the euro. Okay, let's look at that chart soon. But in general, we're looking at euro Swiss at the 108 handle, 107.60 to 109, more or less. And the Swiss National Bank will also be watching the Fed tonight. Thank you, Mauricio, for the very kind words. Question here, do you recommend watching 2 5-minute candles to see the move, or is that too long? Regarding candles, I would wait at least 5 minutes for the dust to settle. It'll also, I believe, will take you and everybody else at least 5 minutes to understand all the moving parts of the initial release of the statement and the dot plot. Okay, so at least 5 minutes, perhaps 10 minutes in total. Question here with the rate hike, the Fed will release an additional summary of measures. This is what I had read previously, different. But today, can you confirm that? The Fed will release a technical paper on the implementation of rate hike. Okay, because we have a range of rates from 0.25. It is expected to rise from 0.25 to 0.50. Okay, so how will it do that? How will it change? There's lots of money as well. One of the questions that Yellen will be asked will be also about the balance sheet of the Fed. Remember, the Fed announced QE, first round in 2009, then 2012, then 2013. It stopped QE over a year ago in October 2014, right? Fed is not printing money anymore. Not exactly the case. So they're not enlarging their balance sheet, but they're maintaining it at the very high level of $4.5 trillion. So for every bond that matures, they buy another one. When are they expected to squeeze their balance sheet? In 1 year? In 2 years? Forever? Probably will never get will not get a clear answer from Yellen on that. Of course, so maybe they will make some changes in the types of bond they reinvest in to support the rate hike. I don't believe this will have a material impact on currency markets. Okay, maybe it'll have an impact later on because maybe the implementation will be tough, and then we'll have to talk about that. I believe they made these reverse purchase operations for nearly 2 years. They've been preparing for a potential rate hike in technical matters for around 2 years, okay? So I believe everything is ready. And the technical part of this should be a no-brainer. I mean, lots of work for them, but not something that will have an impact for markets, okay? What I heard is 15-minute minimum at professional traders' desk. Paul Langham is even suggesting to wait up to 1 full hour. Yeah, if you want to be extra certain, wait for after the press conference, which means press conference usually lasts about 1 hour, begins at 7:30 GMT. So if you wait an hour and a half or even 2 hours after the press release after the big announcement around 9 GMT, then you'll have sort of all the information to understand what's going on. Regarding, that's also an opportunity to say that Mauricio, that is helping here on the broadcast, Valeria Bednarik, well, should say first of all Valeria, ladies first, top analyst at FX Street, and Mauricio and myself will be covering the Fed decision today. We'll begin, of course, before the announcement with the quick preview, and then follow the events. So it's a huge, we'll be very excited, and we invite you all to join along, okay? I talked about Euro Swiss, and let's look at the charts. So I think we've covered the Fed from all directions, right? Yeah. So let's look a bit more at the charts. Last one we talked about was dollar Swiss. Euro Swiss, look, 108 handle. That means between 108 to 109. Low line 107.60. I believe that when Euro Swiss reaches these levels, the S&B intervenes to weaken the Swiss franc, and maybe the high levels here at 109.40 are sort of resistance. So if the euro crashes because of the Fed, the Swiss National Bank will be there to help the Swiss franc crash alongside the euro. Okay? If the euro rises, perhaps the Swiss National Bank will ride on this trend. Perhaps it did that with the ECB to get the Swiss franc as weak as possible against the euro. So the Swiss franc, in theory, in the past, has a historic role of being a safe haven currency. But with all these interventions, I would just look away. Okay, it's my opinion. Any more questions? Yeah, and thank you, Mauricio, for putting here the webinar for the live coverage for today. We invite you all to join along. Question from Fabian. In her latest 2 articles published on FX Read, Kathy Leon poses a scenario where there's still more reasons for the dollar to fall then rise after the Fed raises rates. What do you think of these arguments? I'd be interested in your opinion. I must say I haven't read these articles. And Kathy Leon is one of the smartest people out there, so following your advice, I'll go ahead and read it. What are the reasons for the dollar to fall more than rise? Without reading the article now quickly, I can just assume that the dollar strengthened a lot, that it's priced in, and that the path is gradual. But my argument is that, for instance, the dollar strengthened, but it could still strengthen more because of monetary policy divergence, especially against the euro and the yen, which are going in another direction. The rate hike, if the rate hike is priced in, then also the graduality is priced in. And if what else? Anyway, if you can just put these arguments here on the chat room, just sort of quickly, so I could refer to them. But anyway, I'll read the article and hope to refer to those articles, 2 articles by Kathy Leon, and I hope to refer to them on the chat, on the coverage of the Fed decision at 7 GMT today, and the press conference at 7:30. Our broadcast will start a bit before. Let's look at a few more charts and talk about so we have a few events today. I talked about them. This could see market movements. Market movements will be, I think, more related to the pressure, the tension going on in markets towards this big event. Okay, and then of course we'll have the real movements, the really strong ones around the event, perhaps starting a bit before. We often have these kind of tensions, and then let's see there. Okay, before we reach the wrap up for today, let's look at German PMIs. Let's see how they fared. Manufacturing is more important. Germany is actually manufacturing lots of stuff, contrary to many other developed economies. So manufacturing PMI as expected at 53, and the services PMI, also basically as expected, 55.4. Basically nothing to see here. Move along, make way for the Fed. We have also inflation data today from the old continent, but again, look for the Fed. Okay, so I guess it's time for the wrap up for today. This is the wrap up for the live market open of Wednesday, December 16th. It's Fed day, the big day is here. Our wrap up is mostly dedicated to a preview of the Fed, which is a huge event. Okay, let's quickly talk about what happened so far. Stronger dollar just because of repositioning. UK inflation as expected. German ZU as just a bit above expectations. US inflation is okay, 2% on the core, good enough for a hike. Empire State okay. Manufacturing sales in Canada disappoint, and milk prices rise again, help the Kiwi stand out against other currencies. Okay, today we have a busy agenda ahead of the Fed, even though the Fed will somehow overshadow it. So we have UK employment data. Most important figure to watch there is year-over-year average hourly earnings. Wages expected to fall from 3 to 2.5%. If a smaller fall will be positive for the pound. Eurozone final inflation data not expected to move the needle because it's old data. Building permits, housing starts, industrial output, all from the US, all of importance, but less so today. They'll all need to move in the same direction, either positive or negative, to impact the US dollar. For those trading the loonie, crude oil inventories are to watch, and of course the Fed decision at 7 GMT. So the Fed is releasing its decision at 7. Rate hike is widely expected. Join us for the broadcast. We'll begin a few minutes before that. I think it's not fully priced in, and if it is fully priced in, also a gradual move is priced in. The message we've received from the Fed in recent months is we're going to hike in December, and afterwards we're going to move slowly. If the Fed, for any kind of reason, does not hike, it'll lead to a crash, a total collapse of the US dollar and the credibility of the Fed. Highly, highly unlikely. The Fed is almost certainly hike, even if at this moment they regret it because they prepared everybody for this. Okay? The messages in the statement to watch are what they view the US economy, how gradual they put it in words, and they'll say, of course, data dependent. But apart from words, they're releasing the famous dot plot. Most important in the dot plot is the path of rate hikes, okay? And the median one, the snapshot, the bottom line, okay? In September, these were the numbers: 1.4 median expected interest rate in the United States at the end of 2016, 2.6 in 2017, and 3.5% in the longer run. These were lowered from the previous one. Now they're expected to drop. Dropping will be the dovish hike we're all talking about, the message that we're doing this liftoff, raising rates, moving away from zero, trying to prevent bubbles. The US economy is doing well, showing confidence. And having said all that, don't worry, we're standing by your side, the side of Wall Street, if you wish, the side of Main Street. That's open to political discussions, and we'll move rates slowly. So I believe that a small drop in expectations from, let's look at the dot plot, from 1.4, let's say in 2016, to 1.1 is the dovish hike that is priced in, that is expected, will not hurt the dollar too much, okay? And below that, below 1%, let's say, for 2016, will be very dovish. If they don't move the dot plot, if they don't move the median for the federal funds rate too much to the downside or not at all, this will be hawkish for the dollar, okay? So the statement, the tone of the statement, optimistic, pessimistic, dot plot, key events for the initial reaction. We also have the forecast growth is expected to be lower just a bit from 2.3, unemployment perhaps just a bit, and core inflation also just a bit. That's what the Fed usually does, because employment is doing better than expected, inflation is stuck, and growth is also in with the middle mediocre land. Okay, and then the press conference by Janet Yellen at 7:30 GMT. Main messages: gradual, data dependent, and haven't taken decisions for 2016. So it's not a one and done. One and done will kill the US dollar, because and if it's one and done, why is the Fed moving at all? But they could be more of course, gradual. We're going to move very, very slowly. She will not say when, because that will be data dependent, but she will probably repeat this message. My personal scenario for the Fed is that we'll have perhaps a stronger dot plot than expected. That means the path of rate hikes will remain mostly untouched or just a bit lower. This could strengthen the dollar initially, and then Yellen will be a bit more cautious, a bit more dovish, and that could weaken the dollar. But that all in all, in the morning after, we'll have a stronger dollar, and the real weakening of the dollar will begin only somewhere in Q1 after the holidays. Okay, and that's my personal scenario. The Fed decision reaction in currencies. It depends on the message. If the Fed is saying the US economy is doing well, we're doing a liftoff, employment is good, inflation will rise afterwards, we're confident, good for the United States, good for the global economy, good for risk currencies, for commodity currencies. Strongest is the Kiwi, then the Aussie, then CAD. If they have a worried message, okay, the US economy is doing better, we need to get out of zero, but we're worried about the strong dollar, worried about China, worried about Europe, worried about deflation, things like that. Stronger safe haven currencies, the yen first and foremost, and the euro. Remember, there are many reactions. The statement, the dot plot, the press conference, and then a second reaction in Tokyo, a full reaction the morning after, and the echoes of this decision will be heard for weeks. But once again, I repeat, we're close to Christmas. Liquidity is a bit lower. That means movements can be exaggerated. I don't think we'll have the same range like with the ECB, but if the message is one-sided, all hawkish or all dovish, we could also see that kind of reaction. In any case, the level of choppiness that I expect is high, so trade with lots and lots of care. Okay, so that's a long wrap up for today with a long preview because it's really, really a big day for the Fed. Let's see if we have more questions before saying goodbye. A comment here about infrastructure for 1 million refugees. Don't think I understand the context of this question. Anyway, how often do you guys run these live broadcasts? Really amazing of you guys. Really value for infinite time. Thank you very much for the kind words. Well, Mauricio runs the show in terms of live broadcasts. Basically, they're around big events and on from payrolls, rate hikes, things like that. But he could have a better answer for you. Containers, heaters, building reconstruction. Okay, yeah, that's also investment. Refugees more in Germany than any other countries. And Fabian, thank you for providing some of Lian's arguments. Historically, the dollar weakened 3 out of the last 5 times Fed tightened. And the ECB eased periods, mean reversion, year-end flows. So yeah, historically, we had once the uncertainty went away, once the Fed did begin the tightening cycle, the US dollar reversed its gains and began falling. That's why I expect the dollar. One of the reasons I expect the dollar to begin weakening sometime next year. Okay, but not immediately. ECB, yeah, it doesn't happen that often that central banks move in different directions. That provides lots of volatility, and we're also, of course, grateful for that. In many cases, we see all the world tightening or all the world loosening. Well, in the big financial crisis, all the world went for easy monetary policy. I don't, because of this divergence in monetary policy, I still see a case for somewhat weaker euro dollar, at least in the short term. Mean reversion, yeah, mean reversion. Again, this positioning, the US dollar strengthened a lot, now it could weaken. Year-end flows, year-end flows just cause lots of more choppiness. I think we're not there yet. We should see the year-end flows in 2 weeks, around very close to the new year. Okay, but anyway, Kathy Leon is one of the best out there. I am a fan. Alexei says dollar CAD if Fed goes dovish. If the Fed goes dovish, but on a positive message, we're gonna keep the support, but everything's cool. That's good for the Canadian dollar because it implies more demand for oil. But if the Fed is dovish because of its worries, it means less demand for oil, and that's bad for the Canadian dollar. Do you suggest waiting until 2 p.m. Eastern time before trading? Yes, unless you want to, you have a clear idea of what you think is going on, and you trade with a very, very small amount, then do something before. But I think it's akin to a bet at this point because we don't really know what the Fed is going to do. And JM asks, where can we watch Yellen's press conference? We'll try to post that for you. The Federal Reserve might have a link to that. Usually they use Ustream for that. I hope you can anyway follow FX Rate, Forex Crunch, or Twitter accounts. We'll post things for that, and we'll also cover it live. But if you prefer just seeing the live press conference, that'll be, of course, available, and we'll help you find that as well closer to the event. So it's now it's 9 GMT. We're 10 hours from the big event. If I seem excited, it is because I am excited. Anyway, I think markets are going to be different tomorrow morning. Let's just take one last look at euro-dollar before, and let's see where we have it after. So at the end of the show today, it's at 109, almost 40. Let's see where we open tomorrow. Anyway, that was a long preview, a long show, and a very important day for financial markets. The Fed decision, trade with care. Remember, liquidity is low. I wish everybody a safe and successful trading day. And we'll be here, of course, tomorrow. We'll be also covering the event live just before 7 GMT. Okay, so thank you everybody for coming. Good luck today, good luck tomorrow, and see you. Bye bye.